Hello and welcome to yet another edition of Who Moved the Market. I am Surabhi Upadhyay. Now, pharma stocks have been hitting the headlines of late. We've had this flurry of numbers come through, and some of the other regulatory announcement has managed to keep many of these companies in the hotspot, in the limelight, so to speak. So today we're going to track a couple of more of such names, and we have Ekta back to help us navigate through a lot of the numbers that have come in. Ekta, I guess it's been a really busy season for you, right? Last, I think, some 10 days, it's just been pharma all the way, hasn't it?
Absolutely. It's just the tail end, and luckily this time it's not really been a disappointing tail end.
Yeah.
We've ended the quarter with good result reactions, at least from the likes of, say, Apollo Hospitals, Torrent, as well as Mankind hasn't reacted positively to its numbers, but overall it was a good set of numbers.
Okay, so let's then dive straight in and go one by one. I want to start with the bigger stock, obviously, Apollo Hospitals, the nifty participant, which actually reacted quite okay to its numbers, a percent and a half higher. So tell us what stood out for you before we talk about what the management kind of guided to. But just looking at the numbers, the margin compression that we saw, was that a concern, or is the top line growth more than making up for it? And Apollo has so many different parts, right? So many different businesses within that one combined entity. So help us understand this.
Well, you know, if you saw the stock yesterday post the numbers, it reacted negatively to its numbers. It was down post that, and it recovered nonetheless, but it was in the red. Now, the reason for that is because the consolidated margins came in at a multi-quarter low. It came in at 11.3%. To put it into perspective, at one point in time in FY, maybe during the COVID quarters, they were doing 16% in terms of margins, or close to that, when there was a huge surge in demand that took place. So that's the kind of margins they were generating. Traditionally, you've seen, maybe even 13 to 14% margins for Apollo Hospitals. Now that's come down to 11.3. So that's definitely disappointing. And it affected the profitability as well, which came in below expectations. Now the street was anticipating 190 odd crores. It came in below that. Now, what has gone wrong is, the investments with regards to the digital arm, which the street reacted to yesterday. Yes, the hospital business was great, 18% margins versus 14% year on year. Revenue was 19% higher in the hospital space. But Apollo, the digital health arm, which is basically Apollo Health Co., the revenue was up 31%. So it's growing on a scorching pace. But you do have the EBIT loss that it recorded at around over 80 odd crores. So now one of the theories is that you look at the internals, you look at the investor presentation, the revenue was over 250 odd crores or thereabout for Apollo, for the digital arm this quarter.
Apollo Health Co.
Yeah, for the digital arm, Apollo Health Co., which contains the back-end pharmacy business as well as the omni-channel Apollo 24/7. You can call up, you can book a diagnostic test, you can buy your medicines, teleconsulting, all of that. So that generated, lesser operating cost as compared to the profits, as compared to the revenue. So revenue exceeded the costs of it this quarter. So now the street is anticipating that in Q4 FY24, which the company is guided, it will achieve an EBITDA break-even. So the investments will fall, and at some point in time there will be fundraising to be able to peg a valuation to the business as well. The company themselves said that they would probably look to raise $200 million, dilute around 5 to 6 odd %. That results in a valuation of maybe $3 to $4 billion, which the street is working with. So that is probably the biggest trigger going forward. You already have the core bread and butter business, which is supporting the company, which is your hospitals business.
And no problems there.
And no problems there. In fact, one of the things they said is that their occupancies haven't moved up. It's 64-65%. That's because a lot of the work is now maybe daycare, and that's what a lot of that's probably not the correct metric anymore for hospitals, because a lot of it is reduced stay, a lot of it is daycare surgeries. Medicine has advanced, so your occupancy
robotics, Miss Reddy was talking about that. So many surgeries are happening through robotics, and patients are discharged in a day flat.
Yes, so it depends on the complexity, but that's why the ARPOB has increased. Exactly why she said that, the ARPOB is higher by around 10 odd %. That's because you have robotic machines, like you mentioned. They're doing cancer surgeries, they're doing complicated surgeries, and hence you have the ability to probably charge a little more there, and you are seeing quality as opposed to quantity. And hence for hospitals in general, occupancy will probably not be the key determinant anymore. It'll also be because of the amount of outpatient work that you're doing, which is not captured in occupancies.
Fair enough. Yeah, it's an important takeaway as well, even for future quarters, not to only look at the occupancy level.
You know, Narayana Health said the same thing, that they don't give occupancies because it's just not a clear determinant of what their business is like.
Sure.
You want to be in the hospital as little as possible. So the lesser amount of time you spend, if it's a daycare surgery, you can go in and, you know, be discharged the same day for a minor procedure, then that's great. That's because medicine has advanced.
Sure. Okay, so that's Apollo Hospitals, and those are some of the key takeaways from this one. Let's move to Torrent Pharma. The stock is reacting quite well to its numbers as well. So what has worked for Torrent, and what are the key triggers for this company?
Well, you know, Torrent, it was surprising because it was an absolutely inline set of numbers. The revenue was up 16-17%, the margins 29%, profit at around 330 crores, and Q on Q, it was an exact mirror of last quarter in terms of numbers. There was no movement on a Q on Q basis, but the stock is higher because the commentary was positive, the brokers are positive on Torrent Pharma. What they have said is that basically the India business, which is up around 22%, was aided by the Curatio acquisition, an acquisition they made some time ago. But the margins of the Curatio acquisition have improved this quarter, and they expect further improvement to take place. So that's what the street likes, a fundamental sort of improvement which is taking place in the business. Now coming to other markets such as Brazil, which is up 26% in a constant currency base, that market has done well as well. It's in fact one of the most profitable markets for Torrent Pharma going forward. So that also is an important piece of the puzzle. So the street is actually ignoring or not even paying attention to the US business anymore. $34 million is what they recorded on a Q-on-Q basis. That's an optionality now, that, you know, if in case they do sort of, they do clear the regulatory hurdles that they have in their Indrad facility, which they said they are in talks with the US FDA for, then that would be a great upside trigger for Torrent Pharma. Is it the core trigger? Not anymore, because the $34 million was flat on a Q-on-Q basis. The market seemed to shrug it away because they have other drivers of growth, which is really driving it ahead. 29% margins. I mean, that's what the street likes.
So the key markets for Torrent now would be, I mean, ex of US, which would be
India, Brazil, Germany.
Okay, all right. So it's really diversified across geographies.
Yes, and Germany, and these are traditional markets for them. Germany, in fact, also picked up quite significantly this quarter. That's because the tender business saw some amount of improvement. So the street is liking what it sees when it comes to the other geographies. And generally, when a US business doesn't do well, the market doesn't like it. But in this case, they don't really care about it.
Okay, fair enough. Which brings me to the one pharma stock that I've looked at most interestingly, just because it is the new kid on the block, the new listing, Mankind Pharma. I mean, optically, the 3-4 basic numbers that I looked at seem pretty good. The stock hasn't reacted, but I don't know, maybe that's because the listing anyway was quite a bumper one.
Absolutely. I think a lot of it is already factored in. You know, the street is expecting them to do revenue growth of around 19%, no surprises which came through there. Margins, maybe you could have asked for more on a Q-on-Q basis. 20% margins is what they did versus 16% year on year. And the profit improved as well. The consumer healthcare business, which is basically what Mankind is known for, you know, in terms of top of
brand
mind,
recall,
brand recall. Manforce, Prega News, all of those brands, that was up 10% on a year-on-year basis. The chronic segment, which is 35% of their sales, actually outperformed the market as well. It was up around, you know, it was higher by around 500 basis points as compared to the market in terms of growth. So those are key levers for them. What the street probably doesn't like is the Panacea acquisition. Panacea Biotech, they did acquire the India business for around 1,800 odd crores. Maybe the street is anticipating that there should be some more improvement, some more, you know, some more contribution from Panacea going forward. So I think that's a point of worry. But overall, it's a traditional business where, you know, it gets 97% of its sales from India, and it has a strong brand recall. It was a working quarter for them.
Okay, all right. So Mankind also making its mark in its own small way. Those are the earnings. But, you know, before we wind up, I want to ask you about some of these approvals that you've been talking about, that companies, like I think Sun has an approval from China, Biocon has an approval from China. What's happening? Usually we're always hung up on either the UK MHRA or the US FDA. But what's this China angle?
Well, interesting because China is expected to be a big growth market when it comes to drugs as well. So it is expected to be a large size, 9% of total global market share is what it has as compared to the others. It is just followed, it's just following just the likes of US, Europe as well as rest of the world. And then it's just China, which is around 9% of share. India is just 1%. So the street is very bullish that there is an aging population. There's a there's a middle class that wants to spend. There is health insurance coverage in China. So there is a possibility that there could be rapid growth in terms of the drugs and the accessibility and affordability of that market. So that's the reason why you're seeing interest that, companies have received an approval for the Chinese market. So Biocon has received an approval for an API for a cancer drug and a tumor drug. So that's separate. They're going to be able to manufacture APIs for that particular drug. For Sun Pharma, it's another story because they have received approval for their blockbuster psoriasis drug, which is known as Ilumya in most of the other markets such as the US, and it is a part of their specialty portfolio. I mean, Tildacrizumab, that's the way you pronounce the generic name. But the point is that that's a blockbuster drug for $77 million. And now, the psoriasis market is expected to be very big in China as well. It's expected to equal what we see in the US, around 7 million patients, similar to what we are seeing in the US as well. And hence, it could be the second largest market for Sun Pharma's Ilumya or psoriasis drug outside of the US. And that is what the street likes because eventually it will be a growth driver for them going into FY24. The specialty business as a whole is going to be a growth driver. Will they touch $1 billion of sales? They've gone from over $600 million to over $800 million in FY23. $1 billion doesn't seem too far away. So that could be a possibility. And one of the key drugs to drive it is Ilumya, along with Winlevi, which is for acne, and Sequoia, which is a dry eye disease drug. So these are a couple of portfolio drugs in the specialty market, which are expected to be the growth drivers. Now that they can sell the psoriasis drug, Ilumya in China.
Is this a first? Because obviously China, I mean, if the market opens up, then there's huge potential, as you mentioned, aging population and all the other factors. But is this sort of, first in a series that we're seeing? Indian pharma companies looking to exploit the China market?
It could be because you've seen it as a trickle before, but you might see a flow now. Okay. So you've just seen, for example, maybe maybe Gland Pharma, which is owned by a Chinese company. They've always been interested in the Chinese market. That is a big trigger for them as well. So that is definitely going to be a market that companies do explore. To what extent, it'll be interesting to see. For Sun Pharma, it's an individual opportunity as well that we're talking about. It's specific to the drug.
Got that, Ekta. Very, very interesting. Thank you so much, as always, for giving away all the takeaways, not only on the results, but this China angle with Indian companies looking to perhaps, make inroads in that market as well. Very, very interesting developments there. Thank you for joining in. All right, and on that note, we have to take your leave. Keep sending us your feedback, comments, and queries. We will see you again tomorrow.